Hello everyone. I want to take a look at Group Chapter 8. In Chapter 8 of the course we are talking about depreciation methods, in particular for fixed assets or property, plant, and equipment. So you'll see that I've opened up Excel over on the right. That'll help us out with our calculations again. So what we're looking at is a machine costs $257,500 with a 4-year life. Has an estimated $20,000 salvage value. And remember, salvage value is that arbitrary number. I mean, hopefully we have some type of estimate of what we think an asset is going to be worth at the end of its life, but it is still rather arbitrary in nature. So we list this $20,000 salvage value. It's installed in Luther Company's factory on January 1st. The factory manager estimates the machine will produce 475,000 units of product during its life. Actually produces the following units, and you can see them there. I'm not going to read them all out. We'll see that in a minute. The total number of units produced by the end of year 4 exceeds the original estimate. The difference is not predicted. The machine must not be depreciated below its estimated salvage value, and that is true no matter the method that you are using. You never depreciate below your estimated salvage value. The first one that they're asking us to complete is to compute the depreciation for all years under the straight line method. So here you'll see in our chart, they're asking how much is the expense each year for years 1 through 4 using straight line. So as you may recall, that we always are going to take the cost minus the salvage value and then divided by, the useful life. Well, in this case, what we're dealing with is 257. I have no idea what that was. Sorry about that. Something weird happened there. 257 minus 20,000. And then we're going to divide that by 4 years. So if we work that out, it's 237,500 divided by 4 years, and our straight line depreciation expense is going to be $59,375. So $59,375. Now the question is, what is it for years 2, 3, and 4? Well, if it's straight line depreciation, that's easy. It's always going to be the same. So it's $59,375 in each of these years, and you will see that by the time we get to the end of year 4, the total amount that we've depreciated has been $237,500, which is exactly the cost of the machine minus the salvage value. We move on down to units of production, and units of production is, again, most likely used in a machinery environment, a big warehouse that uses automation for its products. And this is the problem where we need to know how many units were actually produced in each year. The first thing that we have to deal with, this was straight line. I'll just go ahead and label these. Can't type, sorry. It's just one of those days. For units of production, everything on the top is the same, so minus the salvage value, but in this case, it's going to be divided by our estimated total units. So, same thing's happening. We've got 237,500 because we have 257,500 minus 20,000. But now we're going to divide that by the total estimate of production of 475,000 that we believe it will produce. So 475,000, and that will give us, I've got those completely in the wrong place. I'm going to confuse you. I've already gotten off on a wrong foot here. So what we'll have here with our estimated total units is we're going to calculate our depreciation per unit. So if I take the 237,500 divided by the 475,000, and we get exactly 50 cents per unit to depreciate. Well, now if we look at the chart, it says, now how many units did you truly produce? And that's what they're asking us to fill in here. So if we look at our first year, it was 220,000. And then we pop in our calculated depreciation per unit, which was 50 cents. And then our depreciation, I'm telling you, I really can't type. And if we calculate that out, we get 110,000. If we look at our depreciable units for the second year, it was 124,600. At 50 cents gives us 62,300. We go to year 3 and it says we have 121,800. Connect has already filled it in for us at 50 cents per unit. Will give us 60,900. And then in year 4, we take a look and it says it was 15,200. And that would give us 7,600 here, but don't put that in just yet, because that will give you total depreciation expense of 240,800, which is actually 3,300 too much. So without a doubt, if I take 3,300 away from this 7,600, I really should only have 4,300 in depreciation expense. So in reality, I can only really depreciate 8,600 units in order to make this work out to where I don't depreciate it past the cost minus salvage value of 237,500. All right, now we come down to double declining balance depreciation for the period. Recall that in double declining balance depreciation, besides having to calculate the depreciation rate, we must also multiply that depreciation rate by the book value, the beginning of the period book value, as it comes down, because we're going to be writing off much more of the cost at the beginning of the machine's life than we are at the end. The first thing that we need to find, step 1, is to find the straight line rate. And the straight line rate is always going to be 100% divided by the useful life. So if we take 100 divided by 4 years, we get 25%. That's our straight line rate. Our double declining balance, step 2, is to find the DDB rate, and that is always going to be calculated as 2 times the straight line rate. So what we're going to have then is plus 2 times 0.25, and that's going to give us basically 50%. If we were to throw this into percentages, we should work out that way. So 50% is going to be our straight line rate. And the other thing that we have to think about here is that we never ever account for salvage value until the very, very end. Always at the very end. So our beginning of period book value is then going to be cost, because we're going to ignore the salvage value. So it should be 257,500. Our depreciation rate should be 50%, which means our depreciation expense should be 128,750. That leaves us now a book value of 128,750. Again, we're going to end up using a depreciation rate of 50%. That doesn't change. So we should have a depreciation expense of 64,375. That brings us to a new book value. We bring that as our beginning, 64,375. Again, we're going to go with 50%, and that's going to give us a depreciation expense of 32,188 if we round it. I believe they might have said, yep, round your per unit depreciation to 2 decimal places. They want everything pretty much rounded here. This one doesn't say that, but I'm just telling you it's how it is. The book value is now 32,187. It was calculated. So we bring that over, and if we take that 32,187 times 50%, then we're going to get 16,094. And then we look and we have a problem. So we obviously have a problem here. 16,094, and it's leaving us 241,407. So let's just see, and I'm just going to calculate this out so you can see it. Our overage basically was 241,407, but we know that the depreciation, still can't type, that the depreciation needed was going to be 237,500. So our overage is, the difference there is 3,907. So I have to take that away from that depreciation expense. So depreciation of 16,094 less our overage is 3,907. So our final period depreciation should be 12,187, and that should work it out. We have 237,500. What do we do with this 32,187? And I know we run into these things all the time with Connect. Is it right? Should we figure out what 12,187 divided by 50% is to change this? Let's just take a look at Check My Work, see what it does. And it may take a while. I'm using a weird internet connection. And it still leaves it as 32,187, but surely takes this adjustment. Unlike this one, where we needed to take the 4,300 divided by the 0.5 to find this 8,600 to make this work out. Double declining balance isn't doing that. That will complete Group Chapter 8.